Hello, everyone, and welcome back to this episode of the Rose and Rubini podcast, Making Sense of This World. My name is Manas Chawla, and as always, I'm really pleased to be joined by CEO and Head of Research, Brunella Rosa. We're returning our conversation this week to the string of banking crises that we've all been hearing about. And we're fundamentally asking, are these idiosyncratic cases, or are these sort of a precursor to a larger, more systemic possible doom loop returning? But let's just sort of start off with a bit of a bird's eye view, Brunel, because a lot has been going on across the Atlantic. What are the major banks that have been and are in trouble in the United States and in Europe?
So this crisis, so to speak, started in the US, as we know, with the failure of SVB, the Silicon Valley Bank, that was brought into receivership by the FDIC a few weeks ago. And then other banks intervened to take some of the deposits. This happened after effectively and the Treasury announced that there would be a sort of total guarantee on those deposits even above the 250,000 mark, which was a bit of a controversial decision, but was considered essential to avoid kind of further contagion. Other banks that went into trouble were Silvergate and, most importantly, the First Republic Bank, which was offered by a consortium of 11 banks, a sort of lifeline of about 30 billion, that clearly did not prove to be sufficient, and that's why the Fed asked JP Morgan and other banks to acquire First Republic, which is in fact occurred during the weekend. So, this is the US front. In Europe, we are still, for the time being, mm, dealing only with what happens after the kind of forced merger, if you want, between Credit Suisse and UBS, which followed a sort of burden sharing approach by which everybody took a bit of a loss, including 81 capital holders before equity holders were wiped out, something that clearly created lots of discontent in the market. But what we noted already a couple of weeks ago was that the market is already looking for the next potential victim, and is going from the weakest link to the next weakest link, and he identified that to be Deutsche Bank a few weeks ago when a speculation started on its CDS market, although that was stopped there. So these are, I would say, the major banking crises ongoing in US and Europe.
It seems like what you're saying is, effectively regulators are trying to calm markets. In an effort to do that, they're arguing that all these sort of different banking crises cases are all idiosyncratic, essentially happening for their own reasons. Although, what's the reality here? Is there a pattern that connects them, and is there a deeper systemic issue at heart?
So we already said that all banks have been subject to a common shock, and that common shock has been the rapid, large, and coordinated increase in interest rates across the globe. Now, higher interest rates tend to be good for banks because they can charge higher rates on the loans, while they are slower in adjust the cost of the deposits or the remuneration of deposits. So higher rates tend to balance, only to a certain extent, because when they go above a certain threshold, then there's a weakening economic activity, and that reduces the ability of borrowers or repaying the loans, and therefore this tends to be negative for banks. Now, where is this threshold? Nobody really knows. It resembles this distinction between R star and R double star from the Fed, R star being the neutral rate of interest, and R double star being the rates of financial instability, the one that, which you would trigger financial instability episodes. Nobody really knows where they are, but conceptually makes sense that they do exist. So if one believes that that's the case, then banks are all subject to this common shock, and therefore it's hard to say that this is idiosyncratic versus being systemic.
And for a lot of people, this might, raise memories of the 2007-8 crisis. Effectively, the international banking community came together to put in place sort of a number of regulations to avoid a repetition of that sort of event. Are those regulations fit for purpose?
So we actually found that lots of new rules were kind of implemented in the aftermath of the global financial crisis to prevent um, this crisis to happening again. But the point is that as soon as we had to test these new instruments, unfortunately, they don't seem to be really much fit for purpose, or at least not as much as they thought to be. One scary, if you want, statistics that we have looked at is the total assets held by the FDIC insured banks. In 2023, they were as high as they were of all the combined assets of all banks insured by the FDIC in 2008. And this only for two banks. Okay, so we're talking something like 320 billions, just to give you an idea, of two combined banks in 2023 versus more or less 360 billion of all combined banks in 2008. So it's the order of magnitude that is different. So clearly, this is at least the second reason why we believe that this shock might not be idiosyncratic, but may move to become systemic.
Sure. And it seems like kind of as a consequence of the first 2 points, what you're saying is specifically what happened with Deutsche Bank a few weeks ago, might well repeat itself in the future. Is that correct?
Yeah, so that's the thing that we are mostly scared about. Regulators are mostly scared about. So Deutsche Bank went into trouble for a small speculation on CDS and somehow resolved itself. But it may not be the case always. Say that for some reason, the speculation returns, and then over the weekend, regulators, policymakers panic. And when banks are involved, politicians are always involved. I mean, central banks would like to think that this is a job for regulators, technocrats, and so on. But when banks are involved, it's deeply political. There are communities, there's the economy at risk if the only bank is large enough. So they get involved. And if somebody of them panic, they may come up with one simple line. You don't need to have a long statement, right? It's one simple line, which is all deposits will be guaranteed by the government. Now, this tends to calm market. It happened during Northern Rock bank run, and it happened during the Irish banking crisis. But what are the consequences of that? Yes, the market tend to be calmer for a period, then perhaps the bank run stops because people don't have to fear about deposits anymore. But then the burden of these adjustments, so to speak, is brought back on the shoulders of the government and therefore eventually of the taxpayer. So that wouldn't be very different from what we had during the global financial crisis, where the taxpayer money was used to bail out those banks. So we thought we were moved from bailouts to bail-ins. In reality, seems that we are still pretty much in bailout territory. And the case of Ireland is the one that really resonates here. In 2008, the ECB had to activate an emergency loan facility, the ELA. The government had to issue what is called the promissory note. So all sorts of emergency measures just to bring, to take the system together. And this happens after the government of Ireland promised to back a guarantee on deposits and financial institutions. So one simple line may trigger severe systemic consequences.
I mean, an interesting analogy the bankers always use is they're going to try to fix the roof until the sun shines. What does that mean?
Yeah, so paradoxically, this is the phrase that Christine Lagarde used during the global financial crisis or soon after. It was kind of the suggestions to governments Okay, so fix your finances while growth is out there, so the sun is shining. Don't wait for crisis periods to make the structural reforms that are needed to make your economies more competitive and so on and so forth. So it's the typical suggestion that technocrats, so to speak, give to elected politicians. But this time around, I would say this could be the suggestion that analysts, independent analysts, give to regulators and say, look, we know that there are idiosyncratic issues now, but we also know that there's more that can come out, especially in US regional banks and the commercial real estate and so on and so forth. So from idiosyncratic, it can move to systemic. It's not going to happen overnight. During the global financial crisis, it took more than a year between Northern Rock bank run in the UK. Okay, so it was September 2007 to the failure of Lehman Brothers in September 2008. So there's 1 year. In 1 year, lots can be done. So my suggestion is as long as things are more or less okay, so the economy is somehow growing and inflation is abating, clearly there are the emergence of some financial instability episodes, but you're still on time to make sound decisions. If you wait for the crisis to occur, then there's nothing else you can do. It's emergency. You have to promise that the government will cover all deposits, and then you reactivate immediately the doom loop. This is the reason why the Fed has issued its report on SVB. It was pretty damning also on the shortcomings of the Fed oversight, but they also blamed the reforms introduced during the Trump era to make this a regulation-like approach. But as a result of this crisis, they also say there are lots of new regulation that can be introduced for banks or financial institutions in general with more than 100 billions in assets, and they can include stress testing and liquidity requirements. And so if some firms exhibit with the capital planning or poor risk management, they may face limitation to their ability to do share buybacks, or they could be required to issue more capital or hold more liquidity or restrict payment dividends payments and so on, payments of dividends and so on and so forth. So the Fed is starting to move on the back of the idiosyncratic shocks that they see. Hopefully, these reforms will be enough to prevent these idiosyncratic shocks from becoming systemic.
Right. And it's worth bearing in mind, sort of the bottom line of everything you've said is we need to look at the sort of systemic reasons behind these different crises and understand really what's weak in our financial system, where there's a bunch of different moving parts, rather than try to isolate blame in one particular part of the market. So certainly something that we'll continue to watch closely, especially with the warning that we've gotten about how these crises evolve often over the course of as long as a year or more. But as always, Brunello, thank you so much for your time and insight.
Thank you. Until next time.